Hello friends, welcome to Nirmal Bang. I'm Piyush Jain, and today we are going to carry our conversation on the banking sector, the financial sector in the Indian markets. It has been an eventful March so far from the global market perspective. We have heard a couple of banks going under in US. We also actually have seen what has happened with Credit Suisse. Also, we have seen interest rate hikes across Europe and USA. So there has been a lot of global events. Sitting here in India, how actually should we really assess the banking sector? Banking stocks again are directly related to that. What the sort of broader operating environment is looking like? To decode all of that, today we are bringing to you an industry veteran, an expert on the sector, and somebody who actually knows that how the entire system works. Let me introduce to you Mr. Arijit Basu, former MD, State Bank of India, and now the senior consultant of AZB Partners. Mr. Basu, welcome to the show.
Thank you very much, Piyush, for having me here. Thank you.
So you are industry veteran, and such lows and highs, such events you actually have seen in your long career. Right now, for our viewers, if we actually are seeing the global events unfold, could be related to the interest rate risk, the bond risk, whatever reasons. Sitting here in India, do we really have any reasons to worry? Is everything very nicely regulated by RBI? Like, what would be your sort of top few comments on that?
Yeah, so very interesting question. And I will take the second one first. The last comment you made about RBI. So, given the overall circumstances, I think RBI has been navigating the financial market and the economy very well. We have seen how they had been very proactive at times of COVID, the various lines that were made available. You are aware of the TLTRO, etc., which at least allowed the banking sector to remain comfortable. It was good that just before COVID broke out in March 20, the banking sector already had, more or less been able to significantly clean up the balance sheet, the results of which are now being revealed. All the banks have lower credit costs, higher GNPA. And even in the recent past, the issue that has been plaguing the world, you talked of interest rates. So interest rates are linked to the inflation and the other developments in the economy. In fact, if you look at inflation, this has been the highest in possibly the last 50 years. The kind of inflation that was seen in the oil price shock, it has got repeated. So I'll come to that. But before we address that, to answer your question whether we are immune and whether the RBI is doing enough, I think given the circumstances as far as RBI is concerned, they have been fairly on the ball, so to say, quite proactive, taken good decisions. But if you were to ask me whether India will remain completely immune or the Indian economy and the Indian banking system will remain completely immune, that will be a little presumptuous statement to make, in my view. It's not that we are much, much better placed. Thankfully, this crisis, and which has arisen partly due to COVID, and then, by the time we could come out of COVID, we are having the global politico-economic developments, the Ukraine war, the kind of standoff that is happening with China, the Chinese economy itself being very significantly impacted by COVID, etc. All these are playing out. Global supply chains are disrupted. India has remained much better till now. One, because the banking system is stronger. I'm talking of the financial sector. Second, because our growth imperatives, we are still really emerging. We have done very well in many sectors, but the prospect that we can have for our infrastructure growth, our aspirational people are coming into the middle class. So it's, we are starting from a low base. So there is a lot of prospect. Government is investing in capex. So to that extent, it is much better. But at the same time, I'll say that private sector capex is still not fully recovered. Bank credit growth is good. we've seen 15-16% growth, but it's mainly coming from individual retail. The corporate sector is better this last financial year and even this year, but it is nowhere, what may be required for the Indian economy to. And in this circumstances, India is also facing inflation, relative inflation, because in the developed world, inflation was a non-existent thing. You had zero interest rates, etc., after the global financial crisis. But now they are talking of 8%, 10% inflation. In India, we are relatively much better placed. Maybe outside the RBI's zone of comfort of 4 to 5%, but still, 6%, etc.
So
But
for us, sir, it is still okay. It is another 6%. For them, I think it's a big shock, I think.
big shock, because they have not seen anything like this from 1973. If you remember, this is exactly
Yes.
50 from the oil price shock. And so there, the entire problem has been to, in the wake of a stagnant population, how to revive growth. In Japan, so you have people were talking of 0.10% increase in the real interest rates, 0.2, 0.3. These were the short-term interest rates. Now suddenly they have spiked, and which has led to some of the things that have happened in the banking industry. So I'll leave it at that. I think that was the import of your question, that yes, India is better placed. RBI has been proactive, but I think we need to be very, very vigilant. And I'm sure all banks need to be very careful. And RBI, I think, will continue to be, taking the right steps wherever required.
Right, sir. So from that aspect, sir, and I'm asking the question from the perspective of viewers who would be actually trying to sort of link the dots here. So one is inflation has gone up. So high inflation, interest rates rising globally. So RBI also increasing interest rates. Two purposes. One is to combat inflation. And second, also, again, you really need to actually see the interest rate gap between the sort of countries. Remittance also, again, is a big question. So you need to actually look at that also. But then when this happens, how much sort of where we are right now from the perspective of passage of interest rate rise to really sort of impact the consumption demand, which was actually the intent. So right now, what do you think where we are right now? Because when I look at the indicators, everything is very strong.
Right. So if you watch, RBI keeps watching two things very carefully, as does the government, I'm sure. One is the inflation data that comes out, and the other one is the manufacturing growth and, the monthly growth data, etc., both in the services and the manufacturing sector. And in India, it's fairly widely reported by economists, etc. Now, if you see inflation, it's a very complicated, which is why I think the monetary policy committee has not a very enviable job. You have so many, they have tried to narrow it down, but you have a consumer price index, you have a wholesale price index, etc. And generally, RBI had given some kind of a level to which they will continue once inflation comes down to that level. They had indicated that there may not be any further rate hikes, because they can't say what action they will take. But, that stance, which is either accommodative or neutral, that is an indicator. And the feeling in the market, for people like us who follow and the media, etc., was that by now, we are closing this financial year, the rate hike cycle would have played its part. But what it seems right now is that inflation again keeps on giving us, in a way, a half nasty surprise. It seems to have going down. Suddenly it will go up, and depending on which is more worrying, the CPI or the WPI, RBI and the monetary policy members, they are therefore forced to react to that and take a certain call. So again, I would not venture, you are as much aware what people are now saying. The consensus broadly was that maybe there'll be a very small increase, if at all, and we will, in that growth versus inflation argument that is going on, RBI will now try to, with inflation reasonably under control, they will not like to hike interest rates too much. And maybe the cycle would have played out. But now, given the global scenario and with these banks, either collapsing or coming under severe problems, I think it's become a little uncertain. So the messaging that is coming from RBI, I think in 2 weeks' time, we will have the next kind of monetary policy from RBI, which is what we have to wait for. But it's clear that the global cycle does impact India. So in overseas, I think the yield curve is already inverted, which makes it very difficult for, so if you have a long dated 20-year security and that is actually giving you lower yield than a short-term bond, and which is US Treasury, then people will shift to that. So if all that happens, then there will be an impact. Your question was also around whether it can impact growth, very high interest rates, whether it can impact growth. Till very recently, and again, this is anecdotal, what I hear from banking sources. You may be aware, also associated with NBFC, the subsidiary of HDFC Bank, the HDB Financial Services, which I chair. So they also follow the movements very closely. So they are saying that interest rates till very recently, a month or two back at least, was not really a factor which was impeding credit demand in the right kind of segment, especially the individual home loans, etc. But recently, I think I have been just hearing that there is some degree of concern that if there is any further increase, people may, it really might start impacting. As you know, in the personal consumer segment, home loan is the biggest driver because of the ticket size as well as this thing. So home loans might. There was a very secular revival post-COVID, on the real estate sector, residential real estate sector, affordable housing. A lot of people were coming. And see, the dip in demand will happen once the EMIs, etc., goes beyond their monthly repaying capacity. So far, it has not happened. But in case this were to rise further, one cannot rule out that interest rates could start having an impact. Although, by experience, I can say that the importance given to interest rate as a factor in determining whether there will be credit demand for home loans and personal loans is not completely ruled out, but it's less significant than what we tend to believe. There are other factors, which determine it more. The ability, how, the efficiency with which houses are sold, the number of people who are employed, etc., etc. Interest rates do play a part, but not as significant. But yes, at some point in time, if the rate hikes were continue to be high, then there will be. If you have, especially what is happening overseas, sudden hikes of point, even Fed went ahead and did a rise just a couple of days back. So yeah.
Right. But say in that case, if we are right now 15 to 16% credit growth over the last couple of months, do you expect, because one part of the view has also been that due to all the measures, this credit growth might decrease to 11-12% because of whatever measures has been taken over the last 5-6 months. Do you foresee a slowdown post-March? March quarter might be very strong, but June, September, December, as we move in FY24, do you foresee a sort of a mild sort of moderation in the credit growth?
See, there is one thing, whatever be the impact for right since the time I've been a banker, and it seems to be true even for the NBFC industry, the first quarter of the financial year, which is April to June, has always been a muted quarter, right? For three reasons. We found it. One is, the first month, there is an intensity of work which is very difficult to sustain day in and day out throughout the year. The effort which is put in by banks and financial institutions. Howsoever you might make it, procedure, at the end of the day, there is some human effort which also goes in. That takes a dip because of two reasons. One is there is a lot of financial institutions, banks, NBFCs, insurance, you name it, they are all subjected to very close scrutiny and audit. So April is usually a weak month. In the past, we've also seen that while there is growth, there could also be, many cases where people see a slight deterioration in asset quality, and they don't want. No one wants asset to start with any further deterioration in the course of the year. So a lot of effort then starts going into getting things absolutely on board, and this is also a period when it's not the festive season in India, and so you have in the old days we would say busy season and non-busy season. So I think April to June, in any case, one can expect, but year on year there is no reason why, because if we talk of YOY growth, there is no reason why the growth should not sustain over last year, very frankly, barring the month of April. So I don't expect a very major dip, but June to September quarter is when, if there is any negative impact of the global development, we shall start seeing it in growth. Then the second factor is now the composition of the balance sheet of the respective banks. So if you see a bank, in case of NBFCs, there is a lot of variation. Each NBFC has different kinds of portfolios and all. But banks have just started to mirror each other. Public sector banks slightly different because they, by necessity, have a little more of loans to individual farmers, what we call agriculture. Proportion of MSME also, although that has changed because private sector banks have gone into MSME a lot. But all banks now, essentially, more than 50 to 55% of their book is retail. By retail, I mean individual retail. Retail can be very confusing. Some banks add MSME and all. So, and the other part is corporate, mid-corporate, and your small and medium enterprises, right? So, my sense is that as far as corporate is concerned, the factors which will impact the demand will be different. For corporates, it is a question of whether they will invest in capex, whether they are seeing healthy balance sheets. So corporate balance sheet has also become much healthier. So from that aspect, but then the capital investment really, so far whatever we have seen has mainly come from the government or the public sector. Roads and these plants, power plants, renewables and stuff like that.
In the budget also, it's majorly public expenditure which has been announced. Yes,
it is public expenditure because the hope was that private expenditure will crowd in private expenditure. That is what the government keeps saying, but somehow, for whatever reason, it has not really happened. And some of if you remember, credit growth is also dependent on whether there may be investments, but some of the very cash-rich companies, they may not take debt. So if they have sufficient cash, so they go in for that. But so the corporate demand, I think, will come from mainly MSMEs and the mid-corporates, and a few large projects. So that we'll have to see. The reasons for that coming up or going down may not be necessarily only linked to interest rates, very frankly. In the case of the retail individual sector, home loan, personal loan, vehicle loan, this kind of thing, I think there are two things which are playing out at the same time. One is there may be rising inequality, but India is growing. So there are more people coming in. Unemployment is also growing. But the fact is that there are a lot of more people who are getting into employment as long as there is an opportunity, this sector, that sector. And the aspirations,
more people getting into middle class also, and then aspiration to own a home increases.
Absolutely. They want to own a home, they want to spend, they want to buy a scooter, two-wheeler and stuff like that. So that there is a certain momentum. In fact, even in the worst of times for the Indian banking sector, between, say, I would say 2015 or 2016 to 2019. That was a period when cleanup happened. Retail loans still grew. I can share SBI numbers. It still grew at 17, 18%. But corporate growth was actually almost negative. And at that time, so people blame the banks, that banks' balance sheet is stressed, etc. But it's not that we refuse to lend. No banker would refuse to lend. It is just that the demand itself was not there. I mean, the demand could have been there from companies to whom we could not have lent because their risk did not justify it.
Yeah.
So that's a different thing. But demand from people who had their own balance sheets in a healthy manner was actually very muted. And interest rates do play a role, but it's not the only determining factor.
Right, sir. From that perspective, like I'm just taking the momentum from the lending side to the bank's books. Usually, our viewers who would be actually watching the stocks, they would be looking at interest rates and the stocks. But we also know that within the banks, there is a lot of sort of importance in terms of the bond holdings to maturity for investment or for sort of sale. But when interest rates really rise by such an alarming pace within a short span of time due to any volatile reason, what do you think basically right now, what would be happening for both the NBFCs and the banking sector at present with their large bond portfolio and also the mainly government bond portfolio?
Yeah. So I think the lesson that most people are drawing, from these banks is Silicon Valley Bank, First, whatever that name is, and Signature Bank. They are all of one type, as you said, and Credit Suisse, of course, is a completely different. So Credit Suisse is more standard, classical case of misgovernance, mismanagement over the years, and it's not something which has just happened. There was an attempt to, make things better, but I think before they could come out of the woods, all these international crises hit them. So let's keep that aside. But for the other banks, Silicon Valley Bank, especially as a classic example, we sometimes feel, what are the assets or investments that they have put their money in. So you would have read, and I'm just repeating it to give an example. You would have read that what happened was they suddenly had a lot of deposits which came in during COVID, and that was the business model. So all these startups were being encouraged by the venture funds to put money only in SBB, and they also got a healthier return. And it's not that they then took that money and put it into some shell company or some riffraff. They actually put the money in gilded securities, US Treasury asset, and in a way they seem to remain comfortable. Although in principle that should have hit the risk management because that goes against the code of risk management, that you have such large deposits. Many of these chaps, number of depositors are small, relatively limited. Large number of them have $250,000 plus. And anytime there can be, if there is a bulk deposit, there can be a bulk withdrawal. In that scenario, you put money in, long dated 10-year, 15-year securities, as saying that this is HTM and therefore I don't need to mark to market. And very clearly, not in hindsight, they should have had the foresight to see that this is a recipe for liquidity crisis. So
Absolutely.
at the end of the day, asset liability management, your first thing is managing the liquidity risk, right? Above everything else. When we talk of asset liability management, we talk of, and that principle was, so cash, at the end of the day, cash is vital for whether it's a manufacturing company, for a bank, it is a lifeline, I think. But we tend to forget. The fact is that this is, I doubt whether such a thing would have been allowed to continue in the Indian context. But thing is, we sometimes get lured by what is seen on the asset side. What is the quality of assets? So this has woken us up and woken every institution in India to look at their asset liability mismatch, the kind of liquidity that they may have access to. etc. And it's a real wake-up call. We may take comfort in the fact that nothing like this is staring us in the face, but a real lesson. So now, whether it will how the Indian banks are currently placed. So India, two, three things. We have generally been comfortable with liquidity. So if you take the three risks which are talked about in India: credit risk, market risk, and liquidity risk. Credit risk, very clearly, now that percentage might change. If I were to just hypothetically give a weightage, one would say in the Indian context, credit risk is 75%, market risk is 15-20%, and liquidity risk is 5%, in that order. Of course, there are 101 risks, but the core, what we typically in a bank, of course, today the technology risk is equally important, but I'm just saying that these three traditionally have been looked upon. So we have remained fairly comfortable on the liquidity front. Over the last few years, it has been like that, mainly because the credit demand was also muted, and things like that. And there is the balance between AFS and HTM. Broadly, in the Indian banking context, is still something which the banks and RBI is reasonably comfortable about. But again, this is a wake-up call that we continue to do stress testing. That what could be the scenario in which it would go beyond that tipping point, where we might have to actually struggle. In very short spurts, this has happened. We have had episodes, not recently, but in the past, where the call money rates have just gone berserk. If you remember 14, 15 years back. So those were an indication that there is a mismatch, and no bank should be comfortable with such a situation. The other concern is about steadiness of deposits, and there I think household savings has more or less remained the same. It's the percentage has come down, but it's not grown. So the source of funds in this, especially the private banks, need to be more careful, because the public sector banks have a little advantage, because many people get comfort. At least some money they will put in a public sector bank. They'll have at least one account in an SBI or somewhere else, and then beyond that they look out for other banks. So if they are not able to, the growth and accretion in deposits is something which should be followed very closely. There was a situation in the recent past where deposits were growing at 9-10%, and the credit growth was 5-6% more.
It happened with the mid-type PSU banks. Right?
Yes. Yeah, especially. So it's not it can be managed. At that time, they had enough liquidity to be able to manage it, but certainly a wake-up call. So that importance, or the relative importance to the three risks that I talked about, might have shifted a little bit now in the Indian context. I mean, everything is important.
And sir, also, I wanted to also take your view in terms of what usually would have been the impact on the bond valuation, the portfolio valuation which the banks would be sort of holding. I'm just guessing. I'm borrowing your sort of view on that. Is that in such a scenario, usually there would have been a markdown, but it could be HTM, but there would have been a markdown in terms of valuation, primarily because the bonds actually, the yields have gone up, bond valuation would have gone down. In that case, what the banks usually do?
Yeah, so banks, we are required to just follow the RBI guidelines. They have been broadly consistent. There is something, what you call duration, etc. But that's a longer term concept. There's a concept of PV01, which is basically 1 basis point change in the interest rates. What is the impact on your profitability? And banks keep tracking that. Regarding marking, again, HTM, there are some rules. You have to, AFS, you have to mark to market the entire thing. In HTM, so all banks have been doing it. And so there were 1 or 2 quarters, if you follow, I've forgotten exactly which ones, where there was an impact of mark-to-market losses on the balance sheets of Indian banks. And since then, the Indian rates have not spiked significantly. It has been a very gradual increase. So therefore, the mark-to-market losses, etc., have not been that.
But do you expect that to happen now over the next 3-4 quarters? Unless and until the situation reverses and RBI cuts the interest rates and everything normalizes. But in the current scenario, do you expect that to happen? I'm sorry. I'm just trying to link with the any sort of impact on the earnings.
It's a very good question. I understand from where you are coming for. My personal hunch, and you must remember that I've been away from. So as an executive, you are able to respond to such questions even better.
Absolutely.
But my personal hunch, given the figures which are publicly revealed and disclosed by RBI, is that the both the private banks and the public sector banks in India have a sufficient cushion even now. With the kind of credit growth that is happening. So at least for the next few quarters, maybe 2 quarters or 3 quarters, and RBI very clearly is not as unpredictable as the Fed. They keep
I agree with you.
So they consider everything, so they consider the impact on growth and financial stability. These are their the inflation mandate, and they possibly also consider what could be the impact on the balance sheet of banks, right? So therefore, barring once or twice in COVID times, you've never had a spike of even 50 basis points and etc. It's been in the Indian context for overseas. So in India, if you raise it by 0.25 over a regular base of whatever is that, what is that called, repo rate. So it has always been 4%, etc. In the Indian context, and then you raise it a little bit. In there it was 0, and suddenly you raise it by 0.1. So it's slightly different. So I was just wanting to say that the spikes have not been so exaggerated and did not come in spurts, and which has helped the banks. I think your question was, what is the likely scenario in the coming financial year, which is just going to start? We need to wait and watch, but at least the first 2 quarters, I don't see any very major disruption on account of this. That is purely on account of yields and interest rates moving up.
Right, sir. And I'll sum up with my last question, and that will be looking at the inflation, the government budget, the credit growth so far, 15-16%, solid tax numbers, solid toll growth numbers, GST numbers, like everything is looking still rosier. From that aspect, should we sort of say that the sort of financial momentum for the banking sector is looking solid?
Yeah. So banking sector health and growth is both very closely linked to the health and growth of the economy. The Indian economy, very wise economists are there, and they have predicted broad consensus that I can see from both the Indian economists and what IMF, World Bank, etc. is saying, that this financial year, which is 23, is likely to be quite healthy. So because inflation is a little high, so nominal growth minus your inflation would give you the real interest rate growth, which they expect to be somewhere in the range of 6 to 7%, which in the global context, between 6 and 6.5%, sometimes it goes up and down, which should lead to fair opportunity to banks to be able to grow in this scenario. Next year is not so rosy for various reasons. I think the impact, the lagged effect of the disruptions, etc. I think they are talking more of 5% plus, that kind of thing. But given the fact that we have managed to keep inflation reasonably under control, so real growth of 5% should lead to at least a double-digit growth for the banks. And as long as it is done profitably and NIMs continue to be, on an uptick, and we are able to keep costs down. So banking sector will remain healthy. Of course, it will vary from one bank to another depending on their ability to manage things. But overall, it should remain healthy. That's for the next 2-3 years. But I think this is a time when predicting in the future beyond a few quarters is a little dicey, accepting that in the Indian context, the Indian demographics and the state of where we are, we have so much of opportunity. We are still per capita GDP of, even if you take on a PPP basis, we are $5,000, $6,000, whereas the other countries with which we get compared to, Brazil, etc., are almost double. And we still have a growing population, so the demographics, etc., are very, very favorable. But then, of course, there are socio-political factors, which is a different debate altogether, and we have to see how everything plays out, and we are able to work in that scenario.
Right, sir. You have been kind enough and patient enough to answer all our questions. Thanks a lot for coming on the show and explaining our viewers everything about the banking sector, and all the developments which are going in the global markets and the domestic markets.
Thank you very much. It has been a real pleasure, and very topical kind of discussion. So really enjoyed it. Thank you.
Sure, sir. And dear viewers, with that, it's a wrap on the show. Hope you enjoyed it, and we'll see you again.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.